And central banks around the world are charting separate courses when it comes to interest rates. While the US Federal Reserve remains on hold, Europe is signaling a shift towards easing. And emerging markets are taking a case-by-case approach here. Here's a report, take a look.
Financial markets are witnessing a shift in global monetary policy. While the U.S. Federal Reserve maintains a wait-and-see approach, central banks around the world are increasingly signaling a move towards easier monetary conditions. A recent report by Bloomberg Economics forecasts a combined 155 basis points of rate cuts across major economies by 2025. This stands in contrast to the U.S. Fed's projected 75 basis points of cuts in the same time frame. The European Central Bank is leading the pack with expectations for earlier and more significant rate cuts compared to the U.S. This divergence is driven by regional economic disparities. While the U.S. grapples with persistent inflation, Europe faces a greater risk of recession due to the war in Ukraine and ongoing supply chain disruptions. China presents a unique case within the global monetary picture. Unlike many other central banks, China's People's Bank of China has maintained a relatively accommodative stance throughout 2023. This is due to a confluence of factors including a slowdown in the Chinese economy and concerns about a potential property market crisis. India's central bank, the Reserve Bank of India, remains on a tightening path for now. Inflation concerns and currency stability necessitate continued policy action to manage price stability. However, the RBI's future trajectory depends on how inflation evolves and aligns with the bank's targets. Two policymakers have already rooted for rate cuts, suggesting a divergence from the cautious stance. Meanwhile, Russia stands as a stark outliner in the current global trend towards monetary easing. While central banks worldwide are contemplating or enacting rate cuts, Russia's central bank is likely to pursue further rate hikes in the coming months. This divergence stems from the unique economic challenges Russia faces. The war in Ukraine and subsequent sanctions have triggered a surge in inflation. The Russian ruble has also experienced significant depreciation, putting additional upward pressure on prices. Emerging markets present a more complex picture. Some countries like Brazil are expected to hold rates steady after pausing their easing cycles. This cautious approach reflects concerns about lingering inflation and currency stability. The coming months will be a time for close observation as central banks across the globe navigate the delicate balance between controlling inflation and fostering economic growth. Business Bureau, WION World is One.
For latest news, download the WION app and subscribe to our YouTube channel.